Good evening, everyone, and I'm here on behalf of UOB Kay Hian's research team. Tonight, I'll be presenting on Singapore's property sector. I'm presenting on behalf of our property team. They're made up of 3 guys, but unfortunately, they all can't be here tonight. So in tonight's presentation, I'll be focusing mainly on the office segment in the property sector. And 2 of our property analysts actually specialize in this, and they are Vikrant and Terence. So first, before anything, let's take a look first of where we are currently in the REIT space. Now, if you look at that table at the bottom of the slide, it will show you all the countries in Asia that are currently have REIT markets of their own. Currently, in terms of number of listed REITs and also in terms of market capitalization, Singapore ranks number 2, only second to Japan, and at number 3 is Hong Kong. Now, when we talk about REITs, of course, obviously everyone, all investors, want to look at yields. And if you look at now at the top table, at the table at the top of the slide, it will show you the different yields that each of the REIT markets are currently giving. Singapore offers the highest dividend yield at 5.7%. This is in comparison to Malaysia, Hong Kong, and Japan, and even Western peers such as US and even Australia. And in contrast to that, Singapore also offers one of the lowest government bond yields, or your risk-free rate, at 1.4%. And because of this, the difference between the two, the dividend yield and your government bond yield, is what we call the yield spread. Or in other words, this is the extra yield you can get, the extra income you can get if you decide to invest in REITs as compared to just placing your cash in banks or in deposits. So currently, Singapore offers a yield spread of about 4.3%, which is also the highest in comparison to the other REIT markets. And so despite REITs outperforming the STI in 2012, and despite the recent share price strength of our REITs, we still believe that these REITs are still worth a look. There's still some upside there, and they are still worth a buy despite the share price run-up in the past few months. And this is mainly driven by low government bond yields or by low interest rates. Recently, the Fed has been affirming that they intend to keep interest rates extremely low until 2015. And also recently, Japan has also introduced their own aggressive monetary policy easing. And so we believe that Singapore as well will keep their interest rates extremely low. And in that type of scenario, investors or the public will continue to look for more attractive dividend-yielding stocks. Now, to talk more about the yield spread, you can just focus on that chart at the bottom of the slide. The blue line there represents the yield spread, and the red line that runs across the chart is the historical average yield spread in the past 10 years. Now that you can see there, historically, the yield spread has dropped. However, it is still above the historical average. And although this gap here represents about 10% upside, we think that there is still a lot more room for prices to increase, mainly because if you look at it historically in 2004 to 2008, the yield spread actually fell below the average and even went down to as far as what we statistically call 1 standard deviation below the mean. So even though this yield spread continues to move towards the average, we think there's still a lot more room for it to compress, to go even below the average, and therefore we could see upside in terms of price appreciation of the stocks by more than 10%. Now, the property segment in itself is a huge space, especially here in Singapore. So now we try to take a look at in which segment in particular we see the highest value in currently. Now, in the property segment, essentially there are 4 main categories. We have your hospitality REITs, we have your industrial REITs, the office REITs, and last but not least, your retail space. And if we talk about REITs, again, one of the most important factors that you'd have to look at would be the yields. And if you just focus on these 2 columns right here, your current and forward yields, these will show you currently what the dividend yields are for all of the REITs under our coverage. And you can see there that for industrial REITs, currently, this part here is the industrial REIT yields. Currently, they're offering one of the highest in the REIT space, higher than the hospitality, higher than the office space, and higher than the retail space. However, looking beyond the yields as well, we also have to look at valuations in order to determine which of these stocks, which of these REITs are still attractive or still cheap to invest in. So on a valuation basis, we now look at the last column, which we call your price to NAV, or in simpler terms, your price to book ratio. Now, normally the rule of thumb is for price to book, the higher the ratio, that means the more expensive the stock, and the lower the ratio, the more attractive or the cheaper the stock, because it will give you a bigger upside. So on a valuation basis, on a price to NAV basis, if you take a look at the numbers here, it will show you that currently almost all of the REIT segments are trading above price to NAV, except for the office sector. Office sector, currently, the price to book ratios are only above 0.9 to 1 times, in comparison to its other REIT peers trading at about above 1.5 to 1.2 times. So in that regard, we believe that office REITs currently are offering one of the most attractive investment opportunities. And currently, we are recommending our investors to switch to office property stocks. First, again, because of the yield. In terms of yield, office REITs are offering about 5 to 5.5% in dividend yield. And this is in comparison to if you invest in physical office properties in itself, or the physical office space in itself, you will only get an income yield of about 3.5%. Now, some of you may be saying that, but office REITs also make use of some form of leverage, or they borrow some money in order to increase their yield. We also tried to consider that, and based on our analysis, even if you buy physical office properties using some leverage, using some borrowed money, the maximum yield that you can get will only be about 4 to 4.5%. So office REITs still offer at least 1% higher yield as compared to if you invest in the physical properties themselves. Now, besides the yield, again, as I mentioned earlier, on a valuation basis, office REITs are still attractive in the REIT space, offering price to book ratios or price to NAV ratios of only 1 times or less. Now, besides valuation, obviously in the property space, we also have to talk about demand-supply dynamics. And this is actually where we differentiate ourselves from other houses. We forecast that demand in the next 3 to 5 years will be, on average, for every year, will be about 2 million square feet. And this is in comparison to the historical average demand of only about 1 to 1.5 million. Now, where does this extra demand come from? First and foremost, after the European debt crisis, we see the economic recovery happening towards the end of the year and towards the next few years. And obviously, the office sector is highly correlated or moves closely in line to recoveries in economic activity. Now, besides that, I will also discuss in more detail later on that currently what we are seeing is a changing profile of the tenants that are currently looking for office spaces in Singapore. So previously, when the demand mostly came from your global foreign banks, global multinational companies, we are seeing a shift now in the demand coming from more regional banks or your Asian banks, and also from other sectors such as law and accountancy or professional services. And we also see some demand coming from the commodities and the energy space. Now, on the supply side, supply will continue to come in as well. Incoming office space will continue to flow in every year. However, what most people fail to look at is every year as well, there will always be an amount of demolitions or redevelopments happening, and that will eat up into your new incoming supply every year. Now, we saw that happening in 2012, despite incoming supply of about 2 to 4 million. 80% of that was eaten up mainly because of demolitions and redevelopments. And we see that happening again in 2013 and 2014. We estimate that about 50% of new incoming supply will be eaten up, and that will put some pressure on the demand-supply dynamic in the office property space. Now, besides the demand-supply dynamics, we also believe that Singapore's office space continues to remain attractive, especially if you compare it to its closest peer, which is Hong Kong, the only other major global financial center here in Asia. Currently, if you rent an office space in Singapore, historically it will be 25% cheaper compared to if you rent a space in Hong Kong. But after last year's drop in office rentals, Singapore's occupancy costs are now 50% cheaper as compared to that of Hong Kong. And therefore, we believe that as demand as a business continues to flow towards Asia, Singapore will continue to attract a lot of these businesses, a lot of these companies to set up their offices and their headquarters here in the country. In the longer term, we see another trend happening, which is a lot of these office spaces are now moving outside the central business area or the CBD, Central Business District, and the government itself has been very supportive of this move. And later on, I will show you some of the areas here in Singapore where currently office demand is starting to rise. So if we take a closer look at the office demand-supply dynamic, if you just focus on the chart in this slide, the purple or the blue bars will represent your incoming or your office supply every year, and the pink or the red bars will show you the demand for office space. Now, we just start in 2008 when the Lehman crisis hit. Now, in 2008, the blue bars, as you can see, or the supply, continued to remain steady from 2008 onwards until 2011. However, understandably, demand dropped when the Lehman crisis hit, and demand for office space hit record lows in those 2 years. From 2010 onwards, demand started to recover, and we expect it to continue to remain stable in the next few years. Now, in 2012, you will notice here that supply once again dropped to a very low level. And this is what I was mentioning earlier. It's not because there was a lack of new incoming office space in the market, but mainly because this drop in office space is because 80% of it was eaten up by demolitions and redevelopments that happened in the office properties in Singapore. Now, just to take a closer look at that supply side of the equation, this slide, the table at the top of the slide will show you how we came up with a number for the potential demolitions in the next 2 years, within the next 2 years. And we estimate that based on all the press releases, all the announcement, all the news flow, we estimate that demolitions could remove up to 2 million square feet of office space within the next 2 years. And this is in comparison to our estimated new incoming supply of office demand of about 4 million. So you can see that about 50% of that 4 million will be eaten up by demolitions that will occur within the next 2 years. And the table at the bottom will show you how this will impact the incoming supply for office space. In 2013, we estimate that gross new office supply will be about 2.6 million. About 1 to 2 million of that will be eaten up because of demolitions, and therefore we will be left with only a net new supply of about 0.6 to 1.6 million. And this is a similar trend that happened in 2012. In 2012, we had about 1.8 million in new supply, but 80% of that was eaten up by demolitions, and therefore we are only left with about 0.4 million in supply. Now, on the demand side, we expect the demand to continue to be resilient and to continue to be stable in the next few years. First is if you look at the total incoming supply for 2013 of about 2.6 million, based on all the announcement, all the updates that we got from these property developers or property REITs, we believe that about 44% of this 2.6 million has already been pre-committed by tenants. And besides that, if you look at the table at the bottom, like I mentioned earlier, currently what we're seeing is a change in the tenant profile for these office spaces, whereas previously, majority of the tenants will be coming from these global financial banks. After the crisis in 2008, after the crisis in 2010, we are seeing demand coming from other sectors now, which is a good sign, which means that we are less reliant on the financial sector. And we see the demand coming from companies such as Allianz, the insurance company, Shell, Procter & Gamble, NOL, and even SGX, and some commodity companies such as Eastman Chemical. So this is a very positive trend that is happening now. It makes Singapore's office space more resilient. And by basic law of supply and demand, when supply is less than your demand, then definitely you have to expect that prices will increase. So let us take a look now at what is happening with office rentals. The first chart over here will show you two lines. The red line represents your grade A office rentals or your top quality office space. The blue line will show you your grade B CBD office rentals or your second tier office spaces. Now, as you can see, historically, the grade A office rentals has gone down historically and has moved closer to that of the tier 2 office rentals. And it has been pretty stable in the past 2 years, which means that we see little more room for grade A office rentals to move down or to compress further. Now, if we look at the historical trend of office rentals, this bottom table will show you, if you'll just focus on the third column, the year-on-year change of office rentals since 2008. Now, in 2008 and in 2009, obviously office rentals dropped by about 14 and almost 50% in 2009 because of the global financial crisis. It started to recover in 2010, was still up in 2011. However, in 2012, it again fell by 13% because of the European debt crisis. And in 2013, we still expect office rentals to fall, but only by a mere 3%. And after that, once office rentals bottom out this year, in 2013 and in 2014, we expect office rentals to recover by 8 to 13%. Now, we see this trend happening already since the beginning of this year. After rentals dropped by about 13% in 2012, in the first quarter of this year, office rentals only fell by about 0.3%. And so we expect that in the next 2 to 3 quarters, office rentals will continue to fall, maybe by about 3 to 5%. But beyond that, we expect it to rise, starting probably towards the end of this year. But definitely in 2014, we expect rentals to rise by about 6 to 10%. Now, another positive thing to come out of this is the average life for an office lease is about 3 years, meaning in every 3 years, office rental leases will have to be renewed based on the current prevailing market price for office space. Now, if you look at, for example, in 2012, leases that are expiring in 2012 and will have to be renewed this year in 2013 means that these are the leases that were signed in 2009 when the office rental price was at the bottom of about $8.10 per square foot. Now, because of that, this is what we call positive rental reversions, meaning leases that are coming up for renewal will have to be signed at higher rates, at higher office rentals, and this will definitely flow through positively for your office developers and for your office REITs. They will be able to incur higher revenues, higher rental payments, higher property incomes. So besides the demand-supply dynamics, as I mentioned earlier, the office sector is highly correlated or moves very closely in line with GDP growth. And Singapore, although admittedly GDP growth will fall to a new lower normal of about 1 to 3%, this is still relatively more attractive. The economic outlook in the country and the business climate is still more attractive, especially if you compare it to its Western peers in Europe and in the US. And therefore, because of that, we continue to believe that Singapore will remain an attractive destination for those looking to set up office headquarters or office branches or to expand their businesses towards other markets. And here in Singapore in particular, unemployment has never been a problem. Singapore's unemployment has remained very stable, very low, at about 2% or less. And right now, the government is focusing more on protecting jobs versus letting go of jobs. And the other thing to note there is based on industry reports, we expect employment to start picking up towards the second half of this year. And it will come not only from your financial sector, but we also see a good flow of demand coming from other sectors such as public administration and education and other services sectors. Now, on another note, Singapore, if you compare it to other destinations for office demand, such as Hong Kong, which is the closest peer, currently Singapore ranks number 19 in terms of occupancy cost versus Hong Kong, which is at number 1. Now, historically, Singapore's occupancy costs or office rentals are at about 25% cheaper compared to Hong Kong. But after last year's drop in office rentals, Singapore is already about 50% cheaper as compared to Hong Kong. And you will see that in this chart right here at the bottom. The red line represents Hong Kong rentals, the blue line represents Singapore rentals, and the bars will represent the difference between the two. And you will see that historically, starting in 2004, the difference between the two rentals, between Singapore and Hong Kong rentals, has been growing bigger and bigger historically. And therefore, Singapore continues to be attractive in the Asia-Pacific region. Now, if we narrow that down further, Hong Kong has always been the de facto or the default choice for China or for Chinese companies. However, here in the ASEAN region in Southeast Asia, Singapore is still number 1 in terms of strategic location. And just as I mentioned earlier, Singapore is still the top choice if it's based just on cost. And Singapore, strategically, if you look at the neighboring countries here in Southeast Asia, these are the markets that we consider to be emerging or to be developing. And these emerging markets will drive the growth in this region. And these are countries such as Indonesia, the Philippines, Vietnam, Thailand, and even Myanmar. And these countries, we believe, will continue to drive economic growth in the region. And as they expand their businesses, as they expand their economic activities outside of their home country, Singapore will be their de facto choice or their first choice in terms of opening up new businesses outside of their country. Now, in the longer term, we see another trend that is positive for the office property segment. In the longer term, we see the trend of decentralization happening, which means that as the central business area becomes more and more congested here in Singapore, a lot of these office spaces will be popping up outside of the central business area. And we see the government slowly supporting that trend, and they've opened up a lot of spaces outside of the CBD areas, not just for financial sectors, but for other sectors as well, in the mining, industrial sectors, and others. And this map will show you this big circle right here represents your current central business district, and the other circles and this yellow areas right here represent all the other zones or the areas here in Singapore where the government is currently supportive of boosting the supply of office demand. And besides that, we believe that companies or the tenants themselves will continue to look at these outskirts or suburban areas as attractive locations to set up their offices. First, they pay lower rents of about 50% less. It could reach at most 50% cheaper as compared to if they set up an office in the central business area. And also convenience or accessibility will no longer be an issue for them as the government continues to expand the train network. Now, this is also positive for office REITs or the office developers. It presents an attractive diversification opportunity for them, for their office portfolios. They will be able to acquire office spaces or these office assets at a cheaper price. Rent will still be attractive, income yields will still be attractive, and occupancy risk or vacancy risk will be less of a problem as these spaces become more and more attractive to tenants or to businesses or companies. Now, some of you may be wondering, then why not just wait for office rentals to start picking up before we invest in these office stocks? We don't recommend such a move, mainly because the stock market is very efficient. The stock market will price in all these expectations at least about 6 months ahead of when they happen. So right now, if we expect office rentals to bottom towards the end of the year and to pick up from then on, we believe right now this time is the best moment for investors to get into these office-related stocks. And just an example, when we released this report about a few weeks ago, a lot of these stocks have already increased by about 10% at least. Suntec REIT has gone up by more than 10%. A lot of these REITs, a lot of these office property developers have already run up since we released our report. So for today, I'd highlight a few stocks that you can look at just to reiterate our overweight call on the office property sector of Singapore. In the REIT space, our top pick continues to be Suntec REIT. There are some factors that drive our recommendation for Suntec REIT. First is their office portfolio is currently at 100% occupancy or at full occupancy. And why is this so? If you look at the office towers of Suntec, you will see that it continues to be supported by a lot of parking space available, made to tenants, made to customers, made to tenants for their office spaces. And this continues to be an important factor for a lot of these companies when they look to identify new office spaces to lease. And besides that, we also believe that since 2009, as leases are coming into renewal starting in end of 2012 until 2013, a lot of these rental leases are being renewed by more than 20% upside, meaning the leases are being priced at least 20% higher as compared to when they were originally signed 3 years ago. Now, another positive for Suntec REIT is currently, as you all know, they're undergoing renovations for their Suntec City Mall. We believe we see a lot of positives on this side. Phase 1 of Suntec City Mall is already 90% pre-committed, and they are signing in higher rent-paying tenants, which will boost their retail income by at least 25%. And just to give you some of the names of these brands, currently they've already signed names such as H&M and Giant Supermarket, and these good brands will continue to attract or will even attract more customer flow or more foot traffic into their malls. And besides that, Suntec still is located at a very attractive catchment. Currently, it's being serviced by 3 MRT stations, which makes it extremely accessible and extremely convenient for a lot of these customers or retail or tenants. Now, the second pick in our office REIT space is Capita Commercial Trust. Capita Commercial Trust we like because currently it has one of the lowest gearings amongst the office REIT. And by gearing, we mean leverage or the amount of debt that they hold in their books, meaning at a gearing of only 30%, they have about a debt headroom, or they can use about $1.2 billion in debt in order to acquire more properties to add to their portfolio. And this is attractive. Currently, they are in talks to acquire Capita Green in the central business area and also Westgate Tower in Jurong East. Now, besides that, Capita Commercial Trust also has an asset enhancement or renovation works ongoing in 6 Battery Road, but we expect this to be completed by this year, and this should improve occupancy in that office tower, and also increase the rent leases that they will be able to charge their tenants. Now, on the developer side, our top pick is OUE. We see a lot of positive catalysts coming for OUE in the near term. First is they are looking to list a hospitality REIT. Currently, they are working on converting some of their assets into service residences or hospitality assets. We are still positive on the hospitality space itself. We think it will be continued. It will be driven first by the multi-year tourism boom that we see happening until 2015, as Singapore's tourism landscape continues to change with all these new theme parks, new casinos, new attractions coming up. Singapore's visitor arrivals or tourist arrivals will continue to grow at an attractive rate. And besides that, also these service residences will be taken up by as more and more businesses come into Singapore. A lot of these expats or foreign workers will continue to take up space in these service residences. Now, besides that, OUE also has some new office properties coming forward, such as OUE Bayfront and One Raffles Place Tower 2. And currently, we are seeing healthy pre-leasing and occupancy rates. For OUE Bayfront, occupancy is already at 93%. And for ORP Tower 2, occupancies are increasing towards 70%. And last but not least, OUE has always had a good track record of transforming underperforming assets, undervalued assets into high rent-paying assets. And currently, the most recent acquisition that they made was an office tower in LA, in Los Angeles. We believe that in the long term, this is a good platform for them to enter the US market eventually. But in the near term, we view this positively as well, as it reinforces their strategy of being able to identify highly undervalued assets and converting them later on into positive value-adding assets for the company and for the stock. Now, our second pick in the office developer space is Hobie. Hobie currently, one of their office towers, the Metropolis, is seeing very strong pre-leasing momentum. And if you notice earlier, the table that I showed you in terms of tenants that have signed up for new office spaces this year, a lot of them came from the Metropolis, or a lot of them signed up for office spaces in the Metropolis, such as Procter & Gamble, Shell, SGX, and others. And why is this Metropolis Tower so important for Hobie? If you look at the total asset value of Hobie, the Metropolis makes up at least 30% of Hobie's total asset, which means that as the Metropolis continues to perform very well, this will also be a good catalyst and will support Hobie's share price in the stock market. Now, the Metropolis currently occupancy or pre-leasing is already at 60%, and we see that reaching 80% by end of this year, just in time when they become fully operational in 2014. And once they start operating in 2014, this will give them an additional recurring or repeating income stream of about $50 to $70 million. Now, another thing is for Hobie, we see this move towards the outskirts. The Metropolis will be located in One North, I believe, or Buena Vista. We believe this is another sign that Hobie has been a very good investor in terms of which office assets to acquire or which assets to add to its portfolio. If you look at it historically, back a few years ago, before Sentosa became a hot property piece here in Singapore, Hobie was one of the first to come into that market. And right now, it's seeing the trend that slowly office demand will move outside of the central business area. And again, being a very astute investor, Hobie is one of the first in the market to make a move on that and acquire properties outside of the central area. And so with that, with those stock picks, hopefully I got your interest in investing in Singapore properties or in the stock market in general. We believe that you'll be able to outperform the STI despite the lower growth outlook for Singapore in general, and as interest rates remain low, the stock market definitely provides a lot of attractive opportunities for you to generate higher additional income. So now I pass it back to my colleague Tom, who will discuss some of our products and tools that you can use in order to help you identify some of our attractive investment opportunities. Thank you.